Hello everyone, I'm David Presson, Director of Investments for Wealth Management at First Bank. In today's video, I'm going to talk about recent market volatility as well as ways to help structure your portfolio to lower that volatility. First, let's put this year's volatility into perspective. So far this year, there's been 27 days where the S&P 500 has moved more than 1% in a single day, and 8 times it's moved more than 2%. Contrast that to last year, where we had no days of a greater than a 2% move and only 8 days where it moved more than 1%. But going back to the 1950s, we can see that last year was one of the least volatile years on record. What we're seeing this year is more within the norm of range of volatility over time, but we can't let volatility get in the way of making good, sound investment decisions. Sometimes when the markets are more volatile, we'll make decisions based on emotions that we'll regret later. So you want to try to lower volatility in your portfolio, and one of the best and most proven ways to do that is to structure the right stock-bond mix. Since the 1920s, bonds and stocks have only gone down twice together in the same year. In fact, the last time was in 1969, and before that in 1931. And even in those 2 years where bonds went down, they went down only slightly. By putting together a good stock-bond mix, you can again lower your overall volatility and cut down on the downside risk. In fact, since 1950, if you put together a 50% stock-bond mix, there's never been a 5-year period where you would have lost money. In fact, the worst return would have been still a positive 1% annualized return. But you have to be careful that you use the right types of bonds. You want to stick with higher quality short-term bonds. These types of bonds have the least amount of volatility and interest rate sensitivity. Within wealth management, in addition to using high-quality short-term bonds or CDs or short-term bond funds, we look at other strategies that can help lower volatility. This would include within bonds, TIPS and floating rate bond funds, as well as within alternatives such things as merger arbitrage, long-short funds, hedged equity strategies, private equity, private debt, and private real estate. By putting all these together in an overall portfolio, these different investments have a low correlation to each other, so by putting them all together, you can lower overall volatility, cut down your downside risk, and generate more consistent long-term returns. So in closing, I'd like to use a soccer analogy to emphasize my point. In a soccer match, when there's a penalty kick, the goalie has to make a split-second decision. He can either jump left, he can jump right, or stay where he is to try to stop the shot. In a recent study, it was determined that if they jump left, they stop on average about 14% of goals. If they jump right, they stop about 12%. If they stay where they are and do nothing, they stop about 1/3 of all shots. But despite the overwhelming odds of success of staying put and doing nothing, only 6% of goalies decided to take that option. After talking to goalies about why they made that decision, it was found that emotions played a big role. They'd prefer to do something, even though by doing something it lowered their odds of success, versus simply staying put and doing nothing. We can apply this to the investment world as well. When the markets are volatile and falling, sometimes emotions get in the way and we want to do something, even though our best course of action and where we have the greatest odds of success is to stay put, do nothing, stick to our long-term plan.